What's going on, guys? Welcome back to the channel. My name is Tyler. I do want to get into two very important topics that I want to go over with you guys since the markets are closed and it is a Saturday. So I hope you guys do enjoy this video, but I do want to go over when we can expect the AMC MOAS. And just to pre-reference this video, I am not a fortune teller. Nobody on YouTube is, so I don't want to clickbait you guys like some of these other videos that have outrageous titles that don't provide you any context to what is actually being said in the video. What I want to do is go over the average hedge fund size when they could potentially see margin calls, because forget Citadel, forget the Moby Dick shorts per se of AMC. It really doesn't come down to that. It comes down to the smaller guys that will force the bigger guys to cover, and the cost to borrow is essentially eating away at these smaller hedge funds portfolios. The other thing that I want to talk about is the massive standoff that is going on right now with AMC stock. As you guys probably do know, on Friday was the lowest volume day we have seen since we did rally back in June. This is showing me there is a massive standoff that is going on between apes and hedge funds. This is all going to culminate into a big move. Ultimately, I am very bullish from what I am seeing. This standoff is a very healthy thing, something like I have never seen before. So I continue to buy more shares. I am very bullish. Let me know if you guys are continuing to buy AMC. I really like AMC at these current prices, and I think we are due for a massive bounce. But that's not necessarily what we're going to talk about in this video. You guys will get my opinion on that later on into the video, though. Now, if you guys get any value out of this video, hit that like button for me. I do greatly appreciate it. It helps push these videos out to even more apes, and I think every single ape needs to hear what is being said. It's very easy to get carried away with the catalyst, the day-to-day information, so this is a good reminder and a lot of factual data that probably you haven't heard before that does need to be said yet again. As well as that, consider subscribing to the channel. Let me know down below in the comment section if you agree with this, if you don't agree with this. Provide your, take against what I am saying. All of your opinions are very valuable to me. So let's get straight into this video. And the first thing that I do want to talk about is essentially the hedge funds. And what I mean by the smaller hedge funds are going to cause the short squeeze, not the large guys like Citadel and these other very large short sellers. It's going to be the small guys. The cost to borrow is essentially eating away at these smaller hedge funds, and they can only afford to stay in their positions for so long. Because I'm sure you guys already know this, a hedge fund is essentially a pool of money from investors. If a hedge fund is losing money on a position and they're not gaining any money over a certain period of time, they're essentially going to be forced to cover, or clients will really start to question what they are doing in the fund with all of these losing positions that aren't going anywhere. So there is a little bit of pressure. I shouldn't say a little bit. There is a lot of pressure on hedge funds, especially small hedge funds, compared to the bigger hedge funds. Now, what you guys might not know is that a lot of hedge funds in AMC are very large, but we do also have a decent amount of smaller hedge funds. Now, what exactly is the size of a small and a large hedge fund? So a small hedge fund would be, up to $37 million worth of assets under management. A mid-size hedge fund would be up to $232 million of assets under management. A large hedge fund would be $693 million of assets under management, and a super large hedge fund would be over $7.7 billion of assets under management. So a lot of hedge funds are categorized as super large, but in the grand scope of where we sit today in 2021 markets, almost 2022, large hedge funds, 693 million is not very large on a relative basis. There is a ton of hedge funds that are in AMC that have hundreds of billions of dollars of assets under management. So it's not to say, clients of these hedge funds with hundreds of billions of dollars are going to be pressuring the hedge funds to do something with their positions. But the smaller hedge funds, that's where the magic will be made with the AMC MOAS. The small shorts, this cost to borrow, I do want to pull up the Ortex data. The cost to borrow average is 1.56%. The cost to borrow max is 3.22%. But what I want to point out is that back here when we had all of this volatility, really even during this last spike when we went to about $53 per share, you did see a larger cost to borrow. And when these positions are taken out, it's not like an adjustable rate mortgage where it goes up and down with interest rates. It's like a fixed mortgage. So if you got a mortgage, 2019 compared to 2020, your interest rate is still much higher unless you refinance. You can think of that the same way as these hedge funds taking out short positions. So a lot of these short positions were taken out when the cost to borrow was much higher. Now, I don't know the logistics. I've never heard of a hedge fund refinancing a short position, so I don't logically think that is an option. Now, this cost to borrow is going to start eating away at portfolios because this is calculated on a monthly basis. And if, we did go through this rally in June where we did see a lot of short activity happening, some of this was obviously before. I would estimate the average cost to borrow is over 5% for a majority of these short positions. Now, when we are talking about the grand scope of the market, when you would see these smaller shorts be forced to cover, we have seen a substantial sell-off in the overall markets, but we have also seen a rebound at the same time. Now, we are still in the danger zone. We are actually closer to our 100-day moving average. So I have heard a lot of analysts, I keep up on this, I like to hear everybody's opinion on basically everything. A lot of analysts are still calling for a continued sell-off. That is what we've seen towards the end of the day on Friday. And why this is so important is because when you have a high cost to borrow that is eating away at your portfolio month after month, you have been in these short positions for 3, 4, 5, 6 months now, then you are substantially losing on your portfolio value. Regardless of that, the average margin call goes in for hedge funds at about 30%. If you have a 1-to-1 margin ratio, meaning you had $1 million in your portfolio per se, and your portfolio went down 30%, you would essentially be getting close, if not already in a margin call, depending on what kind of positions you have in your hedge fund or your portfolio. Some positions are obviously a lot safer, some are a lot riskier. AMC is a very risky position. So that is ultimately what I expect. When the markets do come down, we don't even have to go down 30%. You're going to see the small guys get margin called, and it really comes down to that cost to borrow that is eating away at these short positions. So even as AMC has pretty much been trading flat, that is still a very bullish thing when we are talking about specifically the shorts being forced to cover. Now, if the small shorts never covered per se, theoretically, the big guys would never be forced to cover. The way I look at this is the smaller guys and the mid-range hedge funds, really from $100 million of assets under management to, let's say, $10 billion of assets under management. That's really where you're going to see the magic happen. You're going to see that price start to go up. Then you're ultimately going to see the big guys be forced to cover if the market is going down. Unfortunately, if the markets are not on a downward trend, then you may not see the large shorts be forced to cover until we are probably hundreds of dollars per share or even thousands of dollars per share. But if your goal is to reach, 100,000 per share or whatever your goal is, that is possible if these large guys wait until the last moment to cover on their short positions. Something else I do want to point out that just basically validates everything that I've been saying. If you guys look over here, the settlement days and the release days for the short interest history of AMC. Right here, the settlement date was May 28th. As we do know, we did rally. This was really, I believe, June 1st through June 4th. We really did see this major rally up to almost $80 per share. Now, the exchange reported short interest came in at 20% on May 28th, only a couple days before we did short squeeze. Now, by June 15th, we only seen a 16.63% short interest. So that only means about 3.3% of shorts were forced to cover. The lowest exchange reported short interest that we have ever got on AMC since especially we did see this rally, or as far back as March 31st, was 14.76% June 30th. So all in all, from the bottom, from $10 all the way up to $80, you only seen about 6% of shorts cover on their short positions. These were the small guys, the medium guys. Now, that's what you guys really need to know. I think that is important to realize that we are going to see a massive move in AMC stock, and it comes down to the small hedge funds. Don't worry so much about Citadel and what they are doing. Yes, I like to make videos about what Citadel is doing to shine light on the fraud and corruption that has been going on, not necessarily per se that they're going to be covering on their short positions anytime soon. They could essentially ride this out as long as they really did want to, as far as the mathematical data and numbers are concerned. But that is a topic for a whole nother video. Let's now talk about the standoff situation that is happening with AMC. And like I said, guys, we had the lowest day of volume on Friday, only 29.5 million for volume. Now, we were pretty flat, down 2.49% regular trading, up 0.5% in after hours trading. What this is telling me is you're not seeing a lot of traders. You're not seeing too much shorting activity, definitely not compared to the short ladder attacks that we did have, you know, essentially since June and before that. You're not really seeing that. So shorts don't want to, you know, fully dive back into short positions or double up, but you're also not seeing apes selling at the same time. You're seeing buying and shorting. They're pretty much neutralizing themselves out. So why I'm calling this a standoff is because we're essentially not doing too much. We're not seeing a lot of activity. And that is what is very important to realize, is that cost to borrow, even though we're not doing anything, you know, on a day-to-day basis, going up 1-2% or down 1-2%, it's still hurting the hedge funds. And you know what makes me so bullish about this, and really ultimately why I continue to buy more shares, is because we are seeing this low volume, because we are not cratering. Once the volume does go back into the stock, you're going to see huge explosive moves to the upside, just like we did see back here on Thursday when we went up about 15% from the bottom to the top of the day. We went up $8, guys. So all in all, I think this is a lot of information that you guys need to know. Watch for the small shorts to be forced to cover, just for your guys's, you know, peace of mind. Let's take a look at what is going on as far as the hedge funds, institutions that are buying or selling AMC. And this is another important thing that I don't want to get into too much, but if the institutions start to buy more AMC, just like they did in the second half of May leading up until that June rally, you're also going to see a huge movement to the upside, because these hedge funds, they are return greedy. They are going to squeeze out their competition if they get the chance to. If we see that technical setup, you know, actually portray itself, you're going to see a lot of hedge funds buy the stock. And also with that low volume, that comes an even bigger move to the upside. Now, we are seeing 1, 2, 3 firms that have reported they sold out completely, but a majority of these firms are holding on to their positions with substantially higher average cost per share. You're looking at the average on here alone is about $47 per share on these average positions, even as high as $51.25 per share on this position right here, another 50% right here, and basically all of these are in the mid 40s range. So if a hedge fund is holding on to their position, that does lead me to believe that we are probably going to go higher, or at least these hedge funds are betting that we do go higher, and they ultimately have more information at their disposal than we do have. So that is going to conclude this video. I don't want to make it insanely long because I could go on and on and on about these two topics, but hopefully you guys understand what is being said. Hopefully you guys got some value out of this video. If you do, drop that like on the video, consider subscribing. Let me know down below in the comment section if something out of this did not make sense to you, or if you just don't agree with what is being said. Let me know that information. Your guys's opinions are very valuable to me, believe it or not. So that is going to be all for this video. If you guys do want to support the channel, link for public, link for Webull down below in the description of this video, as well as the buy and sell alerts. If you guys want to be notified every time a trade is bought or sold in real time, check that out. It pays for itself over and over and over again. So like I said, that's all for this video. You guys enjoy the rest of your weekend, and I will see you in the next one.